Economic recessions are not random accidents. They are recurring phases within a broader economic rhythm that has shaped modern capitalism for centuries. To understand a recession clearly, one must begin with its simplest definition: a sustained decline in economic activity across an economy, typically visible in falling GDP, declining income, rising unemployment, reduced industrial production, and weakening retail sales. Institutions such as the National Bureau of Economic Research formally identify recessions by analyzing these indicators in combination, rather than relying solely on the popular 2 consecutive quarters of negative GDP rule. This distinction is important because recessions are complex, multidimensional events, not merely statistical occurrences. In the 2026 global economic environment, recessions are particularly relevant due to interconnected financial systems, geopolitical tensions, technological disruptions, and inflationary pressures that have followed the pandemic era. Unlike earlier decades, today's economies are deeply synchronized, meaning a slowdown in one major region, such as the United States or Europe, can quickly ripple across emerging markets, supply chains, and financial markets worldwide. This interconnectedness amplifies both the speed and impact of recessions. To understand how recessions happen, think of the economy as a chain reaction driven by confidence and demand. It often begins with a decline in real income adjusted for inflation. When people feel that their purchasing power is shrinking, they naturally reduce spending. This reduction in demand leads businesses to experience falling sales. As revenues decline, companies cut costs, often starting with hiring freezes or layoffs. Rising unemployment then further reduces consumer spending, creating a feedback loop that deepens the downturn. For example, during the COVID-19 pandemic recession, millions of jobs were lost within months, and consumer demand collapsed overnight, demonstrating how quickly this cycle can unfold in a crisis. Recessions are also closely tied to the broader business cycle, which includes phases of expansion, peak, contraction, recession, trough, and recovery. During expansion, economies grow, employment rises, and optimism is high. However, this growth often leads to imbalances, such as excessive borrowing or asset bubbles, which eventually trigger a correction. The recession phase acts as a reset mechanism, correcting these imbalances, though often at significant human and economic cost. Historical examples provide powerful insights into how recessions differ in cause and impact. The Great Recession was triggered by a collapse in the housing market and complex financial instruments tied to subprime mortgages. It led to widespread bank failures, a severe credit crunch, and global economic contraction. In contrast, the dot-com bubble burst was driven by overvaluation in technology stocks, while the Great Depression remains the most severe downturn in modern history, with unemployment reaching extreme levels and economic contraction lasting for years. Each recession has unique triggers, but the underlying pattern of declining demand and rising uncertainty remains consistent. One critical insight is that financial markets often anticipate recessions before they fully materialize in the real economy. Stock markets, driven by expectations of future earnings, may decline sharply even before unemployment rises or GDP contracts. This forward-looking nature makes markets both a warning signal and a source of volatility. For instance, a bear market, defined as a decline of 20% or more, can erode household wealth, reduce consumer confidence, and indirectly contribute to economic slowdown. The impact of recessions extends far beyond investors. For individuals and families, recessions can mean job loss, reduced income, difficulty in paying loans, and limited access to opportunities. Recent graduates, for example, often face particularly harsh conditions, entering job markets with fewer openings and lower starting salaries. Small businesses may struggle with declining demand, while heavily indebted companies risk bankruptcy. On a societal level, inequality can widen as vulnerable populations are disproportionately affected. For investors, recessions present both risks and opportunities. During downturns, many investors shift their portfolios from high-risk assets to safer instruments, such as government bonds or fundamentally strong companies with stable cash flows. Sectors like consumer staples, companies producing essential goods such as food and household items, tend to remain more resilient because demand for these products does not decline significantly even in tough times. However, attempting to time the market perfectly is extremely difficult, and history shows that long-term, disciplined investing often outperforms reactive strategies. Interestingly, some participants can benefit from recessions, particularly those who are well prepared with liquidity and strategic positioning. For example, investors with cash reserves can acquire undervalued assets during downturns, positioning themselves for significant gains during recovery phases. Governments and central banks also play a crucial role during recessions. Institutions like the Federal Reserve often respond by lowering interest rates, increasing money supply, and implementing stimulus measures to revive economic activity. These interventions were clearly visible during both the 2008 crisis and the 2020 pandemic recession. From a strategic perspective, the most important lesson is preparation. Individuals who maintain emergency savings, reduce high-interest debt, and diversify their income sources are far better equipped to withstand economic downturns. Avoiding excessive speculation and maintaining a balanced financial portfolio can significantly reduce vulnerability. In today's uncertain environment, where technological disruption and global shocks can emerge rapidly, resilience is more valuable than ever. Ultimately, recessions are not anomalies. They are inevitable phases of economic evolution. While they bring hardship, they also pave the way for innovation, restructuring, and future growth. Economies emerge from recessions stronger, more efficient, and better aligned with long-term realities. The key for individuals is not to fear recessions, but to understand them, prepare for them, and navigate them with discipline and foresight. The bottom line is simple yet profound. Economic downturns test financial resilience, but they also reward preparation and patience. Those who plan wisely, manage risk carefully, and stay committed to long-term goals are not only able to survive recessions, but often emerge stronger on the other side.
And if you found this explanation valuable, don't forget to like, subscribe, comment, share, and hit the bell icon so you never miss more deep insights into economics, finance, and real-world strategy.